It's Brian Preston, the money guy.
All right, this next question is from Rob. Rob said, if I'm saving for a down payment on another house, I don't know if it's a second home, or I don't know if it's just an upgrade to his current home, would it make sense to put that monthly savings into the current mortgage and then just regain those funds at a sale price? So I'm paying on my mortgage and I know I'm going to move. I know I want to change. Should I just, if I'm saving extra, should I just throw that at my current mortgage, or should I build up savings and cash on the side? I know that I have a pretty strong opinion here, but I'll be curious to know if your opinion aligns.
Well, I get it, because look, I love these type of questions because you can tell he's a financial mutant, because it just seems painful to go build cash savings that are paying less than, even good cash savings right now are paying 0.5%.
That's right.
That's hardly exciting.
Not exactly great.
Meanwhile, if you have a mortgage, your existing mortgage is probably somewhere between 2.5% to 3.5%. Who knows where it is, but it's somewhere in between there. Like, man, it should be great if I could just throw that into, instead of paying 2.5% to 3.5%, you know, I would be paying down that outstanding balance. Here's the problem, and I have an experience here because I actually went through this. And this actually single-handedly changed my outlook. If you go listen to our content, we've been creating content since 2006. And you guys, if you go, you'll see it. I'm willing to admit when my thought process towards money has been updated, and usually it's through my own failures or life experiences. I had a 15-year mortgage. When I was in my early 30s, when my wife and I, we had our house, we loved our house. We did a 15-year mortgage because I was just like all of you guys. I wanted to have the house paid for ASAP. The problem is that then we got, we have we have a special needs daughter who we know we now have to move to a new area so that we can have a good public school system for my oldest, but then we need a special school for my youngest. So that's going to require a move. So we have to leave this house that we love, that we've done all these things with. And sometimes when you get transitioned, because life is kind of interesting how it throws curveballs at you at weird times, it was tough trying to stick the landing of buying a new house, selling the old house, but having a 15-year mortgage that was requiring more cash flow than really I wanted to be spending on that house at that time, that I would have loved to have had a little more flexibility for the house down payment on the new house I was having to buy, as well as the moving expenses to move my family. So that's single-handedly that life experience. I now like 30-year mortgages for younger people because I think it gives you a little more flexibility, not only on the house purchase, but also if you're in a transition period like I was, because you're not having to pay as big of a premium unless you want to. Because there's nothing wrong with prepaying a 30-year mortgage, just like a 15-year mortgage. It's just you get to choose it versus being forced to make that payment.
If you're under 45. Put that out there. Yeah. If you're under 45.
Well, that's true too. But that's kind of the experience share I have. So I would, because of that, I'd want the additional flexibility. Yes, there's an opportunity cost that you're only making 0.5% on the money. But once you put that money in the house, the only way you get the money, prepaying that mortgage, the only way you get it out is to refinance. That's not cheap, by the way.
Yep.
And the other way is to sell the property. And that's not, I mean, it is easier right now, but you don't always get to control the timing of that.
For financial mutants, it's so hard to think about losing that interest cost of that mortgage. I would think about it as an insurance premium. You're paying a very small insurance premium that's deductible, right, when you do your taxes, in order to have flexibility. Because you said it great, Brian. Anytime you go through any life transition, whether it's growing your family, getting married, changing jobs, moving, buying houses, any of that stuff, liquidity is your friend. And so if you have to pay a small premium of mortgage interest in order to have that flexibility, that freedom, that liquidity, I totally think it's worth it.
Well, liquidity equals margin, and margin lets you think clearly versus I think when you're squeezed and you're kind of desperate, you tend to make mistakes. I just will tell you, if you're in a place of desperation, you will do things that might not serve you well 10 to 15 years down the road. Whereas if you have that liquidity and you have that margin of flexibility of life, you can think clearly, you can do the pros and cons list, and you can really navigate things well. And that's why all this stuff is interconnected, and that's why you have to make sure you understand the financial order of operations and how they're all interconnected.
Love it.